Return on invested capital, or ROIC, is one of the most important financial metrics used to evaluate how efficiently a company is using its capital to generate profits. It measures the return a company makes on the money it has invested in its business operations. Essentially, ROIC shows how good a company is at turning its invested capital into profitable returns. To break it down, the formula for ROIC is net operating profit after taxes, also known as NOPAT, divided by invested capital. NOPAT represents the company's core earnings without the influence of taxes or debt interest, providing a clear picture of its operating efficiency. Invested capital is the total capital a company has invested in its business, typically including both equity and debt. Now, why is ROIC so important? This metric is crucial because it helps investors and analysts understand whether a company is creating value or destroying it. A company is considered to be creating value if its ROIC is greater than its cost of capital, which is often referred to as the weighted average cost of capital, WACC. If the ROIC is lower than the WACC, it means the company is destroying value, as it's not generating enough returns to justify the capital investment. How to calculate ROIC? Let's dive deeper into the calculation. As mentioned, the formula for ROIC is ROIC equals net operating profit after taxes, NOPAT, divided by invested capital. To understand this better, let's define the two main components: net operating profit after taxes, NOPAT. This is a company's operating income after taxes but before interest. It shows the company's ability to generate profit from its core operations, independent of its capital structure. The goal of using NOPAT is to remove the effects of financing decisions, like taking on debt, which might distort the profitability picture. NOPAT is a cleaner measure of operational efficiency. Invested capital. This refers to the total amount of money that has been invested in the company's core business. It includes both equity provided by shareholders and debt provided by lenders. This total represents the funds the company has at its disposal to grow and operate the business. It can be calculated as total assets minus non-interest-bearing liabilities such as accounts payable or deferred revenue. To give an example, let's say a company has a NOPAT of $200 million and its total invested capital, combining both equity and debt, is $1 billion. The ROIC would be ROIC equals $200 million divided by $1 billion equals 20%. This means that for every dollar the company invests in its business, it generates 20 cents of profit. A high ROIC, like 20%, generally indicates a company is effectively using its capital to generate returns. Why investors focus on ROIC? Now let's discuss why ROIC is so critical for investors. The key reason is that ROIC allows investors to determine whether a company is using its resources efficiently. A high ROIC generally indicates that a company has a competitive advantage because it's able to generate more profit from each dollar of invested capital compared to competitors. For example, companies like Apple and Microsoft have historically had high ROICs, often well above 20%. These companies consistently generate strong returns from their invested capital, reflecting their ability to dominate markets, innovate, and maintain efficient operations. However, ROIC is also useful for comparing companies within the same industry. If two companies operate in similar markets, and one has a significantly higher ROIC, it could indicate better management, more efficient operations, or a stronger competitive position. ROIC versus other metrics. ROIC is often compared to other metrics like return on equity, ROE, or return on assets, ROA. While all three metrics provide insights into a company's profitability, ROIC has certain advantages. ROIC versus ROE. ROE only looks at returns generated from shareholders' equity, ignoring the impact of debt. ROIC, on the other hand, accounts for both equity and debt, providing a more comprehensive view of how effectively a company is using all of its capital. ROIC versus ROA. ROA focuses on the company's assets, but it doesn't differentiate between assets funded by debt versus equity. ROIC provides a clearer picture of how well a company is using its total capital, making it a better metric for evaluating companies with different capital structures. The importance of comparing ROIC to WACC. As we mentioned earlier, one of the most critical uses of ROIC is comparing it to a company's cost of capital, known as WACC. The WACC represents the average rate a company must pay to finance its assets, including both debt and equity. If a company's ROIC is higher than its WACC, it's generating returns above the cost of its capital, creating value for shareholders. Conversely, if ROIC is below WACC, it's likely the company is not efficiently using its resources and may be destroying value.